Hey, Tom and Mary. You guys won't be able to talk, but I saw you
Mm,
guys jump in here. I know we're waiting. I'm just gonna give people another minute. I know we're waiting on some others to pop in, so I'm just gonna give them a minute and then we'll start right on time. You guys feel free to use the chat. There's a Q&A too, but the chat is fine. Here's Frank. Morning, Frank. Good morning, everyone. All right. So, JT, what do you say we get started just for sake of time? I
Yeah,
know we should be expecting a few others, but they can funnel in as we're talking here. Um, yeah, thanks for the few of you guys who jumped in right on time. Always appreciate that. Here's Jim now.
I'll admit people as they
Okay,
come in
cool.
for you.
Yeah,
I'll handle the
appreciate it.
chat as well.
Yeah, go birds for the fans out there. All right, so we're gonna get started, guys. Appreciate everyone jumping on this morning. As I or in my emails and to these registration links, you may have seen that we're going to be doing these monthly on a monthly basis. We're keeping them short and sweet, 30 minutes. You know, if people have questions, feel free to type them in the chat as we move along, and we can get to those at the end. But just for time's sake, we're going to try to keep everything within that 30-minute window. We're going to run right through the presentation here. And this week we are speaking on pretty much just the basics of life insurance. And I thought this would be a really good topic. It's a question I get all the time in terms of like, okay, what are the different types? What are my options out there? So this is just going to be a very, it's going to be an overview to understanding life insurance, the different types that exist, and a guide for helping someone choose the right plan. What we see very often is that a quick Google search can become very confusing like that. There are so many different conflicting opinions, facts, fictions, whatever you're going to read out there. We're trying to give people the tools to form their own opinions with this information. So, without further ado, let's jump into the presentation here. Most of you know me, all of you know me, Dylan Hallahan. I am the Director of Long-Term Care, Disability, and Life Insurance for our department. I've been with Emmanuel Insurance for 4 years now, and in the industry for about 10. This is all I've ever done. We've become very, very passionate about these areas of insurance for our clients, whether business owners, individuals, families, whoever it might be. So we're hoping this can be another great stepping stone to education for people. And with me, I have JT Crosby. JT, if you want to introduce yourself.
Yep. I'm the Executive Director of Sales and Risk Management for Emmanuel Insurance. I'm going into my 15th year, and I manage all the departments, the personal lines, the commercial lines, and partnered with Dylan for the life, disability, and long-term care. Thanks for joining us.
Awesome. So just quick introduction. So what is life insurance, right? And most of you may know this, but life insurance, really the main purpose of life insurance, the first thing of it is you're insuring your life. It's insuring your life for if, God forbid, something did happen and that person were to pass away, you're protecting your family, you're protecting financials, you're protecting debts, and you're helping your family maintain a certain lifestyle. Is just in that passing, an event of a passing. So, you can see here, pay off debts, cover future expenses as well. Why is it important? Um, I mean, simply put, my own words, it's to protect what matters most in your life. It's protecting your families, your debts. It's a matter of the building in that peace of mind while you have all this family and these things to protect. So the different types of life insurance. These are the four main types of life insurance that exist today. The first one here being term life insurance. I call it temporary life insurance because that's what it is. We have whole life insurance, universal life insurance, and variable life insurance. I'm going to go into detail, a little bit of detail for each of these, but these are really the four main pillars here when we're talking about life insurance for our clients. So first up is term life. Again, I refer to it as temporary life insurance. I think that's the easiest way to gather as to what it really is. Essentially, you're renting your life insurance for a set period of time, fixed price, and a fixed death benefit. So these are all the great part about it is it's very cost effective. They're usually for a specific period of time. So most cases we see 10, 20, or 30 years, right? There are some wiggle room within those, but most time it's between 10 and 30 years you're looking at for term life. And it just simply you're to pass away within that set period of time, that certain term, death benefit is to be paid out. If you do outlive the coverage, well, the insurance carrier says, "Hey, congratulations, you won the game. You outlived, and see you later." That coverage is no more. So the key features and kind of the reasons why people would look for term life insurance or consider is there are very affordable premiums for a good amount of coverage. There is no cash value component to term life. They are renewable. So when you do get to the end of your term, they are technically guaranteed renewable, but your premiums will skyrocket. So most scenarios, it does not make sense to renew, but they do give you the option. And there's convertibility options. So that's really key. They build in convertibility so that you're able to convert a portion or all of your term or temporary coverage into permanent coverage. So more like that whole variable indexed policy. And then there are also return of premium options. You do pay more for that right, but return of premium is an option as well to fit to your term life insurance. Basically, it just means if you get to the end of your term, you're refunded your premiums that were paid into the policy, which some people like. Some people would rather put those premiums elsewhere.
Dylan, where do you see that normally when you're placing those kinds of policies?
Return of premium?
Yeah.
Most cases I see it where someone does not like the aspect of, well, I'm going to pay all these premiums for 20 and 30 years for possibly nothing, right? Most people, quite honestly, most people outlive term insurance, right? That's why it's so inexpensive, is because these insurance carriers are hedging their bets. They're saying, yep, you're going to outlive this. So that's someone who says, hey, okay, at the end of the day, I at least want my money back if I outlive it, right? And then I'll figure it out from there. And maybe they don't necessarily have the healthy enough budget for a permanent policy, right? So like for a true indexed or a whole life policy. So they're just looking to get their money back. At the end of the day, it's how I explain it is it's almost like a forced savings. You're not earning any interest on it, which is the caveat to it. But at the end of the day, you could be getting tens or hundreds of thousands of dollars back at the end of your term, which would be nice.
When you're working with businesses, do you see like this in buy-sell agreements a lot, where they're like, okay, we want to make sure that we're protected, but also like let's not just waste the money. Are you seeing that more?
Yeah, absolutely. Again, it comes down to the bottom line. If it fits within their budget, whether they want to because you will generally pay about double the premium.
Yeah.
Relative to term, right? So generally, it varies, but yeah, absolutely, it's a great way for a company to fit it within their buy-sell or whatever type of planning that they want to do, and just not lose out at the end of the day, essentially.
Right. Thanks.
No problem. So yeah, this is really best for the best scenarios are individuals seeking temporary coverage, obviously. They cover a mortgage. So that, if someone has a 30-year mortgage, they want to cover it. Children's education for a period of time, or they want to lock in their insurability, like the convertibility options. They want to lock in their health today at an affordable budget to be able to convert in the future. Whole life insurance. So whole life offers a lifelong coverage, includes a cash value component, which the term does not, and that it grows in time with dividends. So all of these permanent, I qualify all of the whole life index and variables permanent policies, they all just grow in different ways. They all accumulate value in different ways. Whole life uses dividends, which essentially says when a mutual company that you have your whole life policy with has a profit, they pull a profit this year, they say, hey, okay, we pulled a profit this year, let's share in that profit with our policy owners. You're almost buying stock within the company, but it's not a true stock. They're just sharing a certain percentage of their profits each year. Key features are their fixed premiums, guaranteed death benefit. They have tax deferred. This is the reason why a lot of people like these types of permanent coverages is there's tax deferred cash value growth, and there are tax advantage, generally tax-free benefits and loans that you can take on your policy. So you can loan against your cash value, and it's a tax-free benefit, and generally speaking, as long as they're designed correctly. And also death benefit is tax-free with any life insurance, with term as well. Another nice thing is there are a lot of different riders depending on the company and the product you're going with. There are a lot of different additional riders you can add just for additional benefits. You could add long-term care, you could add additional term life to it, and other certain benefits and different bells and whistles, so to say, that you can add to a permanent policy that you couldn't necessarily on a term policy. And the whole life is really best for someone who is seeking mid to long term. It is not a short-term play for sure. It is a mid to long-term financial plan that someone is fitting within their current financial plan, mainly for not only the death benefit, but for the tax benefits and for estate protection with less risk. There are less risks to a whole life just because it's not tied to the market performance whatsoever. It's just tied to the dividend payments within that company. So you want to make sure you're selecting a very strong, financially stable mutual insurance company when you're looking at whole life. And if anyone has questions on any of these, type them on in the chat and we'll make sure to get to them again. Universal life insurance, mainly focusing on indexed. So definition of the universal life is it is a flexible policy that combines life insurance with a cash value component that grows over time using index fund interest. So whole life was dividends. This is using indexed fund interest. So it's almost like it is. It's tied to the market, but those indexes are able to provide, you can see, they provide certain protections and possibly caps on what you're going to gain within that. So the key features are their flexible payments. For the most part, you want to be able to stick to the plan, but there are flexible premiums within this. So you can go up and down within certain parameters in your premium payments. There are coverage and index allocations. So you have flexibility to choose different coverage amounts and index allocations as to how you're allocating your growth potential within your policy. There are, again, tax deferred cash value growth, just like the whole life. They do provide a interest rate floor again, so you are protected from the downside of any market turns. We hit a 20-30 point decline in the market, you're just hitting zero. So you are protected from the downside. Your policy is not losing on that, on the index interest. And then there are tax advantage, again, benefits and loans, just again, like the whole life. Generally, they're going to be tax-free. As long as it is designed and funded at the correct levels and we keep a good eye on it, you're going to be able to take advantage of those tax-free benefits and cash value loans that you take from it. One thing that you want to make sure you consider is there may be, most scenarios, there's a surrender charge for the first 10 to 15 years. Basically, that's just to keep you in the game. They don't want to see someone lapse a policy or take their surrender value in the first few years. It's really not worth it to even do that. So really, you'll see surrender charges on there. After 10, 15 years, it's kind of the range. There's no penalty, no fees. It's, again, just tax-free benefit you're receiving. And this is really best for someone who is looking for flexibility in their policy, again, with the premiums, coverage levels, and index allocations, and the potential for higher cash value. So because it is tied to those index funds in the market, you do have better upside potential over the long game, as opposed to the whole life, where it's a little more even keel. You're not really seeing any ups and downs within it. Moving on to the variable life insurance. This one combines life insurance with investment opportunities. These ones have changed quite a bit over the last few years. They used to be much more volatile, but still, they allow cash value to grow based on market performance. So there definitely is a little more risk with these types of policies. Key features are their investment options for cash value growth. So again, it's just a different way to grow your cash value and also your death benefit. There's a potential for higher returns with higher risks, of course, but there is an upside potential there for sure within these policies. The death benefit is tied to cash value performance. That's important. We've seen a lot of, especially some of the older policies, where they're just not kept a close eye on. They're not funded to the proper levels, and the policy will essentially eat away at itself. If you really do not keep a close eye on it and make sure you review every year, which that can be a sad story for a lot of people. So you want to make sure you're keeping your eye on all of these policies, but especially a variable life. Again, tax deferred cash value and tax advantage benefits. This is across the board with any life insurance policy. As long as they're designed in the correct way, you're going to have really, really great tax benefits with these types of designs. And they are really best for individuals that are comfortable with more investment risk. So maybe they're a little more savvy. They're seeking higher potential growth, though. So there is a definitely an upside potential, but you want to make sure that you're really you're keeping an eye on it, and you're make sure you're aware of those risks. You got to keep in mind as well, it's tied to your life insurance, right? So I depending on what your end goal is, you may not want to tie something where you want guaranteed, something that you want to be for sure left to your family, tied to investment risk. But again, it's all dependent on someone's goals and needs at the end of the day.
Is that why you think that indexed universal life is used more than variable, because it's just safer and it's still tied to the market?
It is. I think there's a couple reasons to that. I think, yes. I think there's also a little bit of, most people don't like a whole lot of uncertainty. I think variable life, they're harder to explain to someone. There's a little more of I guess, lack of education, for lack of a better term. It's just, I'll be honest, I'm not a huge fan of them. It's just not for everyone. There are plenty of people that are able to take advantage of it. I'm just not a huge fan of it tying in investment opportunity with life insurance. I think if you want to play the market, go play the market, right? And take your investment risk elsewhere, rather than within your life insurance. The indexed universal, it just provides a lot more downside protection, which I like, especially when we are tying it to a life insurance benefit, that's really meant for family and protection needs. So to each their own, but yeah, I mean, I can speak for my own practice, and JT, this, we probably do more universal life, a little bit of whole life, and definitely some term too for the budget conscious.
Yep. Yeah, it seems like we do a blend. A lot of times when it's somebody that's trying to, that's financially stable and they're looking to put things, in place, the need for life insurance is greater during the younger years, the earning years. So a combination of term and some permanent insurance together, whether that's whole life or universal life, depending on what they want to do. That's a
good point, because that's a question we get too, or that's a most. I shouldn't say most, but there are people out there that don't even realize they can have more than one life insurance policy. They'll ask me like, "Dylan, can I have more than one?" Like, yeah, you could have 10 if you really want. It wouldn't make sense to have 10 because you're paying additional fees and costs, but it's tied to the benefit amount. So they will max you out to an insurability level that they feel comfortable. And they just won't over-insure you to that, right? So yeah, you could absolutely, and we do that many times, to where we're trying to get you to a certain death benefit amount to protect your needs and wants and goals, but also within a certain budget, we want to maybe fit in some cash value accumulation, make your money work for you a little bit, and also give you some longer horizon growth and potential and death benefit protection.
Yeah, I know for myself, I have 3 policies on my life. So
yeah, exactly. I think I do as well. Yeah, 3 or 4. So yeah, you can see here comparing the options, just the kind of a nice little chart here to see the different options. I won't really go through them since we already did. But this, I'm happy to send this to everyone as well. We'll send it out so you can kind of get a quick overview as to the different types. But this is really just the main points are what they are best for. I would really focus, the best scenarios. At the end of the day, our goals are to protect you to the right amount that's going to help you sleep soundly at night. Because that's what life insurance at its core is. It's insurance on your life. So we want to make sure that we're getting you the correct death benefit amount. And then within certain budgets, we want to consider, okay, well, what type of insurance is best to help you reach those goals? And, we have plenty of clients that do a mix. They do one, they focus on term for the cost effectiveness. They think they only need it for a certain period of time. Great. And then we're looking more into the permanence for someone who wants to actually build some accumulation, wants their money to go towards something and have them actually work for them, essentially. And then just some questions to ask yourself. I think these are some really great questions for someone who doesn't really know where to start, or maybe know what different types exist or what type might be best for them. And when we're looking back at this chart, these questions will help you determine, okay, well, maybe I want to consider more term, more whole life, more whatever, whichever one it is. So number one is, what are your financial goals? I know, Mary, this question, right? Someone's financial goals are going to determine, okay, how do we want to design this around them? Are they looking more short term? Are they looking more for accumulation and tax advantages for the future? Retirement supplement. So what are my financial goals? And then we can kind of fit in a design to help them reach those goals using life insurance. How much coverage do I need? This is always an important one. I always ask this question up front to someone. I say, okay, have you talked about with your significant other how much coverage you'd like to have? Have you done a financial analysis or a needs assessment at any point? Most cases is they have no clue, or we get the throw a number against the wall number. They say 500, a million, 2 million. I'm like, okay, great. How'd we get there? So it's really determining how much coverage do you realistically need. Oh, there we go. How long would you like your coverage to last? Are we looking for temporary coverage, or are we looking more long-term, or some sort of mix? Am I comfortable with investment risks? This is more when we're talking about that indexed or variable life. How risk adverse are you, or how risk tolerant are you? And do we want to tie that to life insurance? Or do we want to, again, send you Mary's way, being an advisor, and say, hey, great, go work with Mary on the investment side, and let's focus on the life insurance here. And then what is your budget? This is an obvious one, right? And it's, again, something we want to figure out right up front to make sure we're designing everything within a comfortable budget. I always tell every client we talk to, I'm like, I'd rather you start comfortable and work your way up. I don't want to be completely shocked with hundreds, thousands of per month into doing some permanent policy, and then they end up not being able to afford it down the road. And now all that work for nothing, and all those premiums for nothing. So it's a budget we definitely want to be able to determine and be comfortable within, but also help you reach your goals, right? And help you maximize your coverage. And with that, we'll turn to some questions. That's all I had. Here's all my information. I know most of you, if not all of you, have it. But here's all my information. Thank you again. If anyone does want to jump off, feel free. A few minutes early too. I know we had some questions come through, JT, right?
Yeah, I'm going to go through the questions. If you can go back to the last slide, I just want to share some of my thoughts when I'm talking to people about life insurance.
Yeah. Sure.
Because that question comes up, how much coverage do I need? So there's life insurance calculators out there that can actually determine that. I like to talk to people because people want to know right away, like ballpark. If you're in your 30s, then I would say that you want to have at least 20 times whatever your annual salary is. That is a good ballpark number that I like to use for that. If someone's in their 40s, then I say that you would like 15 times your annual salary. And if you're in your 50s, at least to have 10 times whatever your annual salary is because of those earning years. And I think that's when you go through a life insurance calculator, you can see that. One of the other things I wanted to touch on, Dylan, is the GUL, the Guaranteed Universal Life, because those permanent policies that create cash value, Well, there's also a permanent policy out there that doesn't create any cash value that is basically term for life. So it's a really good way to make sure that you have a policy that's going to be in place. Again, more expensive than term, less expensive than a policy that's going to create cash value for you. Mary Saylor asked a really good question in the beginning. Do you see folks buying life insurance on their young kids with cash value build up to use for college or home purchases when older, while having a small death benefit just in case? And both Dylan and I insure our children. As soon as my kids were born, I put policies in place on them. One, to lock in their insurability in case anything happens. Each of them have $100,000 death benefit on them, and I'm overfunding the policy. Not so much that they have money for college, possibly by the time that they're ready to purchase a home, but more so that it's just creating generational wealth for them, because at the time that I bought these policies, they're putting in it's paid up in 15 years. So the cash value when they're 65 is like over $300,000, and that's what it's projected to do. And so like they can take that money without any tax implication and supplement their income. But yes, locking in their insurability is part of it. If you're going to overfund a policy for your kids so that they could use for college, you would really have to overfund it very quickly in order for it to build that. I think probably 529 plans are probably a better investment to than using a life insurance policy for that. But if someone's purchasing their home like in their 30s, that could possibly be something that you could do. And then Dylan, I'll toss this one to you. Mary asked, do you usually tell clients to max out their life insurance through employer and then buy an outside policy just because it's so cost effective and no underwriting?
Yeah, absolutely. I think if your employer offers it, why not take it? Especially if it is some sort of guaranteed issue policy. It's probably going to be dirt cheap if you're paying for it at all. Just because they're spreading out that risk within a large field of employees. So yeah, I always say, hey, if you have it, and most people do, I think, take advantage of it for the most part, at least that I see. But if they're not, yeah, absolutely, we want to take advantage of that cost-effective coverage. The key to that, though, is just it's knowing that, okay, that policy is not portable, most likely, right? So if they do leave, retire, what have you, that policy very, very well may not go with them, right? So most scenarios, they are not portable, right? So that you just got to be able to consider that it's only while you're working with that employer. If you do go to another company and they don't offer life insurance or a lesser amount, well, you've just got to deal with that. So that's something to consider. We definitely don't want to rely solely on employer coverage, but it is definitely absolutely you want to take advantage of it because most of the time it's a why not.
Yeah,
so inexpensive.
And to just tag on to that, Mary, if you're looking at it, depending on the employee's age and their health, like, does it make sense, depending on what kind of plan that the employer puts in front of their employees, because there is no underwriting, typically they're rating them on a table basis if it's like a big group plan. Other policies that are in place where, like, for us, Emmanuel Insurance provides life insurance for no cost, up to 1 year's salary, up to 100,000. Like those things are, absolutely take advantage of that. Make sure that your clients are signing into that. It's those group policies that you want to just see. Does it make sense to have your own coverage or to pay through your paycheck to join the group? Yeah. Any other questions out there?
Just Mary grilling us.
Yeah, I love it. She's always got great questions.
That's why I bring her, right?
Yeah. Dylan, great job. Your knowledge is excellent, and so I can't thank you enough for this. And I'm looking forward to the next workshop. Do you have that date by chance?
We do not, no, but it will be announced. Actually, you know what? It is. It's the third Wednesday. So what is that date?
Third Wednesday of March. That will be the 19th.
There you go. 19th
Perfect.
again.
Great.
So yeah, we will have another one on the 19th. I'll be sending out again the registrations. Yeah, thanks so much for coming, guys. Mary, Tom, I appreciate it. Appreciate you guys supporting us, and hopefully you learned a little something, took away, a little something from it. And always feel welcome to reach out, guys. Everyone on here. Thanks, Frank. Appreciate you, man.
Thank you. Good stuff. Thanks, Dylan.
Yep. All right. You need anything? You're good?
I'm good.
Okay, cool. I will catch you.